We are very pleased because we are making very good progress in our integration plans, but also at the same time we had the first quarter we returned to a very strong net profitability on a reported basis, strong underlying profitability. We also saw our capital getting even stronger. Lastly, we see clients still seeing us as a strong partner across all our businesses. So we are very pleased with the progress we make so far, but still work to be done for the rest of the year.
When it comes to net new assets, these for the first quarter came in at 27 billion. It's slightly lower from what we had seen at the end of last year, but ultimately my question is, are you still on track to achieve the 100 billion you forecast for this year?
Well, if you look on a pro rata basis, we are slightly above, but of course we may see some volatility on a quarterly basis around this target. Our focus in the next 2 years is to look at, first of all, restructuring our balance sheet, the financial resources that may lead into a lower growth of net assets. That's the reason why we target 100 billions. And then from 2026, we expect this growth to go towards 200 billions a year. So you can see there how managing our balance sheet and financial resources may lead into a slower growth, but still is a very sound one. 100 billions a year will be a pretty good result.
And tell us about net interest income, because you're also guiding to a lower performance when it comes to that for the rest of the year. Is this ultimately just a result of a different rate environment, or there's more to it?
Well, first of all, I think if you look across the board in dollars, we do expect, we are factoring in unexpected 3 cuts between now and year end. So I think that still the jury is still out to see if this is really going to happen, but this is the assumptions we are basing our outlook. In Switzerland, we do expect 2 rate cuts between now and year end. So all this translates into a lower NII. I think that this, of course, we are assuming that client behaviors in terms of how they look at deposits and off and on balance sheet items won't change. But on the other end, we are making good progress in our cost reductions. We are seeing also very good inflows in our net new fee generating assets. Therefore, we see ample room to compensate for this headwind.